I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. Nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started, it kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to, whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical treasure, the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and the defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged, because we're still in a dollar short squeeze where there's more debt than dollars that exists, and that's what's going to happen. Yeah, you can come up with 1,000 reasons why it happens, but before we go into the reasons why, we just have to remember that this is what has happened every time since 1918. Since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. So it was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold, like obviously, what's that word? Not sporadically, like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is the most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best. And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down. And either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and then he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine. So, I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15-1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up. Limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down. I think it's just a peculiar thing going on with London, because the ETFs happen to be stored, their metals happens to be mostly stored in London. I think SLV has a little bit in New York, but the amount of silver in being stored for SLV in New York hasn't changed in many years. It's the same in the same JPM vault. What changes is the vaults in London. So it's just signaling that London, which is the main physical spot market for the world, is short on silver. Not that they're selling it short. I was saying they don't have enough supply, and you can see that in the float, because they have to store for the ETFs. And though ETF storage is not anywhere near where it was in 2011, it's slowly building back to that as investment demand is growing. So silver squeeze was an interesting movement back in February 2021. Now is when it could really succeed, because if people bought a bunch of silver ETFs, then they could really blow that spread out, because then London would really need the silver to be shipped there immediately. It's just so it could keep the ETFs in line with price. Because what would happen to these ETFs this is my theory, that if SLV, for example, couldn't store or couldn't buy silver because there wasn't enough in London, then how would it be tethered to the silver futures price? It couldn't be tethered, and then you'd have the SLV, because it was lacking shares, just spiraling higher and higher and higher, and then that would create a feedback loop where it would force London to import silver from anywhere it could at any price, just to keep SLV under control, and then you'd have this positive feedback loop that I don't know how they would get it back in control. That's what Silver Squeeze was trying to achieve. And I think it could achieve that now, specifically because of the spread between London and New York. But why I say it's not backwardation is because New York silver is a different good from spot London silver. According to Mises, in his book Theory of Money and Credit, he differentiates between goods in different places, or technically different goods. They're similar goods, but they're different. Because let's say, a bushel of wheat in a starving African country is not the same good as your marginal bushel of wheat, in some warehouse in Nebraska, or whoever grows wheat. It's worth very little there, but it's worth a lot in Africa, or whatever country might be starving there. So what backwardation would be is New York spot silver, meaning October silver would be this month, would be more expensive than, let's say, December future silver. That we're not seeing yet, but we will see that, and when we see it, we'll know that silver is really in backwardation, and then things could get pretty spirally. No, there's always enough silver. There's no such thing as a silver shortage, because there's no such thing as a gold shortage. The only question is, what do you have to offer to get people to give it to you? How much are they going to go for, right? We've seen we've seen the staggering amounts of silver in New York vaults. It's still it's still above 500 million ounces, which until like, you know, 4 or 5 weeks ago or whatever it was an all-time record. There is silver. There's a lot of it. You know, even London has a lot of silver. It's just most of it is being stored in ETFs, and in New York, most of it's being stored by who knows who owns this stuff. It's there, it exists. It's just people aren't selling it for the $50 that the exchanges say that it's worth now. So, what does the price have to go up to in order for this silver to be dispersed, you know, to the masses or to whoever wants it? It's probably prices are going to have to go up. Yeah. And in the meantime, you have these market actors that can mess with the price. I'm not saying in a nefarious way. It's just I don't know exactly what is causing silver to sell off a few days ago specifically then. So the reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started at the peak of the balance sheet was sometime in 2021 for the last 4 years, maybe 2022. I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them. The bank reserves. Now, I had a theory which ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night because they're trading the reserves. So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio. The bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion. And this week's number, which should be out in a few hours, I think 2.5 hours it'll be out, and I'll check it. It should be like something like $80 billion less because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like 930 something billion dollars. It was whatever it was like 60 or 70 billion dollars more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion, so it's like 2.91 trillion or something, and the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves run out. It's being used and sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding, as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just they're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. It's going to end soon because the repo rate is already moving several basis points a night. It's already tight.